Welcome to part 2 of our discussion on budgeting for people with irregular income. In part 1, we explored why irregular income creates financial stress and how uncertainty affects our thoughts, emotions, and financial decisions. We learned that financial stability does not depend on earning the same amount every month. Instead, it depends on creating consistent financial systems that work even when income is unpredictable. In this second part, we will focus on practical strategies that help freelancers, gig workers, consultants, entrepreneurs, and self-employed individuals build long-term financial stability. We will also examine the psychology behind spending, saving, and investing, and learn from the real-life experiences of successful investors and financial educators. One of the most effective budgeting strategies for people with irregular income is the minimum income budget method. Instead of building your monthly budget around your average income, or worse, your highest income month, you build it around the lowest realistic amount you expect to earn. This creates a financial safety net because your essential expenses are always covered, even during slower months. Once your minimum budget has been established, every dollar earned above that amount becomes strategic rather than emotional. Instead of asking, "What can I buy?" the better question becomes, "How can this extra income improve my future financial security?" This simple shift changes the way people think about money. High-income months are no longer invitations to increase spending. They become opportunities to strengthen financial resilience. Another important strategy is immediate money allocation. Many people make the mistake of depositing income into a single account and deciding later how to use it. Unfortunately, the longer money remains unassigned, the more likely it is to be spent impulsively. A more effective system is to give every dollar a specific purpose as soon as it is received. For example, every payment can immediately be divided into categories such as essential living expenses, taxes, emergency savings, investments, business expenses, and discretionary spending. By making these decisions immediately, you reduce emotional spending and replace it with intentional financial planning. This approach reflects an important lesson from James Clear, author of Atomic Habits. Clear explains that successful people rely on systems rather than motivation. Motivation changes from day to day, but well-designed systems continue working regardless of emotions. Automatic transfers to savings accounts, scheduled investments, and predefined budgeting rules reduce the number of financial decisions you must make, making good habits easier to maintain over time. Taxes deserve special attention because they represent one of the most common financial challenges for freelancers and self-employed individuals. Unlike salaried employees, gig workers usually do not have taxes automatically withheld from their earnings. As a result, many unintentionally spend money that should have been reserved for future tax payments. A practical solution is to immediately transfer a fixed percentage of every payment into a separate tax account. Although the exact percentage depends on local tax laws and individual circumstances, the principle remains the same. Tax money should never be treated as available spending money. Separating it immediately removes temptation and significantly reduces stress during tax season. Another valuable financial tool is the sinking fund. While emergency funds protect against unexpected events, sinking funds prepare for expenses that are expected but do not occur every month. Examples include annual insurance premiums, vehicle maintenance, computer replacements, professional memberships, software subscriptions, business equipment, or holiday expenses. Rather than allowing these costs to become financial emergencies, individuals gradually save small amounts throughout the year. When the expense eventually arrives, the money is already available. This simple habit transforms large financial obligations into manageable monthly savings goals. Building an emergency fund is equally important. Financial experts generally recommend maintaining enough savings to cover 3 to 6 months of essential living expenses. For people with irregular income, this reserve serves not only as financial protection, but also as psychological security. Knowing that essential expenses can be covered during slower months reduces anxiety and allows individuals to make better long-term decisions instead of reacting emotionally to temporary setbacks. Behavioral scientists Sendel Mullainathan and Eldar Schaffer explain this phenomenon in their book Scarcity. Their research shows that when people constantly worry about money, much of their mental energy becomes focused on immediate financial concerns. This reduces what they call cognitive bandwidth, making planning, self-control, and problem-solving more difficult. In other words, financial stress itself makes effective financial decision-making harder. Creating savings and financial buffers helps reduce this mental burden and allows clearer thinking. One of the greatest dangers for freelancers is lifestyle inflation. As income increases, spending often increases alongside it. A larger apartment, newer car, premium subscriptions, more frequent dining out, and luxury purchases gradually become part of everyday life. The problem is not enjoying success. It is allowing temporary increases in income to create permanent increases in expenses. Warren Buffett provides a powerful example of resisting lifestyle inflation. Although he has accumulated enormous wealth over many decades, he has consistently maintained a relatively modest lifestyle. His approach demonstrates that long-term wealth is often created not by earning extraordinary amounts of money, but by consistently spending less than one earns and allowing investments to compound over time. Thomas J. Stanley reached a similar conclusion in The Millionaire Next Door. After studying thousands of American millionaires, Stanley found that many wealthy individuals lived surprisingly ordinary lifestyles. Rather than spending money to appear wealthy, they focused on saving, investing, and maintaining financial independence. Their research challenges the common assumption that visible luxury reflects genuine wealth. Psychology also plays a major role in spending decisions. Gig workers frequently experience recency bias, where recent events are assumed to predict the future. After several profitable months, it becomes easy to believe that high income will continue indefinitely. This often leads to increased spending based on unrealistic expectations. Another common bias is optimism bias, the tendency to believe that negative events are less likely to happen to ourselves than to others. This explains why many freelancers postpone building emergency funds or purchasing insurance, believing they will always find enough work. While optimism can be motivating, relying on it instead of preparation creates unnecessary financial risk. Present bias presents another challenge. Human beings naturally place greater value on immediate rewards than future benefits. This explains why buying something today often feels more satisfying than saving for a goal that may take years to achieve. Recognizing this tendency allows individuals to create systems that favor long-term success rather than short-term gratification. Charlie Munger devoted much of his career to understanding these psychological tendencies. In his famous lecture, The Psychology of Human Misjudgment, he argued that many financial mistakes result from predictable mental biases rather than a lack of intelligence. Understanding these biases helps individuals recognize emotional decision-making before it influences their financial behavior. Robert Kiyosaki has also emphasized the importance of financial education. Through Rich Dad, Poor Dad, he encouraged readers to understand cash flow, distinguish between assets and liabilities, and think beyond earning wages alone. Although some of his investment recommendations have generated debate among financial professionals, his broader message remains valuable. Financial education empowers individuals to make more informed decisions about earning, saving, and investing. Long-term wealth depends not only on saving, but also on investing consistently. For people with a regular income, percentage-based investing often works better than fixed-dollar investing. Instead of investing the same amount each month, individuals invest a consistent percentage of every payment they receive. This approach adapts naturally to fluctuating income while maintaining the habit of regular investing. Compounding is one of the most powerful principles in personal finance. Small, consistent investments made over many years can grow substantially because investment earnings generate additional earnings over time. The earlier consistent investing begins, the greater the potential long-term benefit. This is why financial discipline during the early stages of a career often produces greater results than trying to invest much larger amounts later in life. Angela Duckworth's research on grit reinforces this principle. She found that long-term success depends more on sustained perseverance than on exceptional talent. Financial success follows the same pattern. It is rarely built through one extraordinary decision. Instead, it grows from hundreds of ordinary decisions repeated consistently over many years. Perhaps the most important lesson for people with a regular income is that stability is created by behavior rather than income. Two freelancers earning exactly the same annual income can experience completely different financial outcomes. One may struggle with debt and financial anxiety, while the other steadily builds wealth and financial confidence. The difference is rarely income alone. It is the systems they follow, the habits they practice, and the psychological discipline they develop. In conclusion, budgeting for a regular income is not about predicting the future perfectly. It is about preparing for uncertainty with confidence. By building a minimum income budget, allocating every payment intentionally, maintaining emergency reserves, planning for taxes, creating sinking funds, investing consistently, and understanding the psychology behind financial decisions, anyone can create lasting financial stability. As Benjamin Graham wisely taught investors to remain calm during market fluctuations, individuals with a regular income should learn to remain calm during income fluctuations. Financial success does not belong only to those who earn the most. It belongs to those who build systems that allow them to manage uncertainty with discipline, patience, and consistency. Thank you for watching this two-part series on budgeting for people with a regular income. I hope these insights help you build stronger financial habits, reduce financial stress, and move confidently toward long-term financial independence. Remember, income may be unpredictable, but your financial behavior does not have to be. If this video helped you understand budgeting better, subscribe to Budget and Build for more beginner-friendly finance tutorials.